Good afternoon, everybody, and welcome to today's webinar on the ever-changing rules around the Foreign Account Tax Compliance Act, otherwise known as FATCA. With us today is Cyrus Daftary, International Tax Attorney with the law firm Burt, Staples & Maynor, and Jeff Cronin, VP of Product Strategy with Convey. I just want to mention a few things before we get started. Today's webinar is sponsored by Broadridge Financial Services along with Convey. Broadridge is a leading provider of investor communications and technology-driven solutions for banks, broker-dealers, mutual funds, and corporations globally. And lastly, I am Melanie Beckett, and I will be your moderator for today's event. All participants today will be on mute for the duration of this event, so if at any time during the presentation you'd like to submit a question, please type it in the questions box or the chat box. If you cannot see the questions box or chat box, just hover your mouse over the green bar at the top of your screen until your WebEx panel appears, and then select Q&A or chat. All questions will be reviewed, and we will respond to as many as possible during the Q&A session, which will be held at the end of the webinar. By attending and participating in today's event, you will be eligible for 1 CPE credit. This presentation is a basic level course with no prerequisites and requires no advanced preparation. Per NASBA requirements, in order to receive credit for today's event, you will need to answer the polling questions and fill out the evaluation survey at the end of the event. This is very important for you to know. You need to fill out or answer the 3 polling questions and fill out the evaluation survey in order for us to issue a CPE credit to you. CPE credits and certificates will be sent to you 1 week after today's date. One other thing I just wanted to remind you of is to take advantage of more in-depth discussions on FATCA and other tax and regulatory topics by attending Convey's annual tax and regulatory conference, also sponsored by Broadridge. The 2002 C2 Summit will be held at the Omni Dallas Hotel in Dallas, Texas from Sunday, September 23rd through Wednesday, September 25th, 2012. Convey's C2 Summit is a live tax information reporting seminar that includes a half day of Convey solution training and 2 full days of regulatory and compliance sessions. You can visit c2summit.convey.com for more information and to register. And now we have our first polling question for you, and to get started, please indicate on our first poll whether or not you require a CPE certificate for today's presentation. If you do, please mark yes. If not, please mark no. And we'll give you a moment to fill this out. Thank you. Okay, we're going to get started then after you go ahead and fill out this polling question. Please just follow along on the presentation. I'm going to introduce Cyrus Daftary. Cyrus?
Thank you, Melanie. And good afternoon, everyone. We are going to, actually, if we go to the agenda slide, Melanie, please. We're going to spend, if you will, the next 40 minutes or so discussing some of the latest things about FATCA. We will cover, if you will, the basics for those of you who may be new to FATCA. We'll talk about some of the recent developments. Given that the bulk of the attendees are what are called U.S. withholding agents or USFIs, I will focus on USFIs, but we will speak about IGAs for those of you who are attending from overseas. We'll talk about implementation considerations as well as the IGAs, and then open it up to questions in the end. If we go to the next slide, let's just talk about the purpose of FATCA. Essentially, FATCA is a vehicle that the U.S. government has put in place really geared towards stopping tax evasion by U.S. persons. As many of you probably are aware, as a U.S. person, we are required to pay tax on our worldwide income. The challenge has been, though, that some of our fellow colleagues have not done that. and what the IRS is really trying to do is crack down on that. And it may be helpful to kind of take a look back in time to understand why we are where we are now. And that is, back in 1997, the IRS actually did a study, and they found out that $3 trillion left the U.S. untaxed. And they were convinced of two things. One is that a lot of U.S. persons were going overseas, reinvesting the money back in the U.S., not declaring a tax. And two, they were convinced that a lot of people, let's say someone who was in a non-treaty country, let's say in Saudi Arabia, would go over to the UK and then reinvest some money back into the U.S. and avail themselves of a UK-U.S. treaty rate, when in fact they should really be subject to the UK-Saudi rate, in which there isn't one. So we had that, and that brought about, if you will, the 1441 rules, QI rules, and now FATCA refers to them as the Chapter 3 rules. We've had some recent disclosures that might surprise you. I believe that the recent disclosure amounts, there are 300 individuals who came forward, and the IRS picked up $1 billion in tax. These are not expatriates who've gone overseas for their company for several years, left $10,000 in a bank account for spending money when they went back to, let's say, Europe for travel. These are people who obviously have significant assets. And I think this was highlighted, of course, as many of you are aware, by several global financial institutions that got hit with some pretty large penalties with the U.S. government. But bottom line, the purpose of FATCA is really to stop, if you will, tax evasion. I joke around and tell everyone that what FATCA has done is made the entire global world agents of the IRS, and now everyone gets to have the benefits of, or the headaches of collecting, if you will, all this information, and none of the benefits, of course. So if we go to the next slide, the basic requirements really is three parts. We could break it down into due diligence, withholding, and reporting. It's important to note, though, that this doesn't really change the NRA rules, QI rules, Chapter 3 rules. This is, think of FATCA as something that is simply a filter that sits on top of the existing rules that are in place. Okay, essentially what's going to happen is, whether you're a U.S. withholding agent or whether you are a non-U.S. entity, you're going to have to go through due diligence reviews of all of your account holders. And you're going to have to decide, if you will, are they U.S. or are they not U.S., and if they're undocumented, you're going to have to apply the appropriate presumption rules. Now, I should mention, I know that there are several MNCs, multinational corps, on the phone, and if you represent an accounts payable function, what's important to note, for the most part, your ordinary accounts payable type of functions and payments should fall out of scope of FATCA. If you are involved in, let's say, hedging, or if you're involved in any type of loans, or if you're issuing any dividends, then you potentially could have a FATCA headache that you have to deal with. But if you're talking about buying, generally speaking, goods and services, you're not going to have a FATCA headache, except for when we get to the WH, you're going to get the ripple effect of dealing with the headaches that come with the new WH, because the WH have grown significantly in size. So now if we move to withholding, the basic premise of withholding is we have 30% withholding if we cannot properly document someone. And then we have reporting obligation, sorry, Melanie, next slide. We have a reporting obligation at the end of the day to, if you will, report on our U.S. account holders, and or if they're what are called recalcitrant account holders, we're going to have to identify those. And a recalcitrant account holder, from a U.S. perspective, is basically an entity that is either going to be classified as a non-participating FFI or a non-compliant NFFE, which is a non-financial foreign entity. And then from outside the U.S., of course, you can also have individuals that could be recalcitrants. So let's just jump into some of the recent developments, just to give everyone a flavor for what's happened. The IRS in February this year released, if you will, the draft regulations. These regulations are 388 pages long. We are expecting, if you will, the final regulations. The IRS has often said we would see it late summer. I really don't think we'll see it. Obviously, there's only 2 weeks left in August. I really don't think we'll see it anytime before October, but be on the lookout for it in the fall. There were, if you will, some joint statements by the U.S. and G5 governments talking about this concept of a FATCA partnership, and on July 26th, the IRS, as well as the G5 countries, released what they call the Model 1 agreements. These are intergovernmental agreements, and we'll talk about those. And we are expecting, if you will, what they're calling Model 2 agreements to come shortly thereafter. And so for those of you who have been following this, you know, for example, Japan and Switzerland had announced that they were in discussions. They had a joint announcement, and so we expect to see what their agreements are going to look like. So let's just jump into some of the basic due diligence rules from a USFI perspective. First of all, understand, and it's important, I think we should talk about this for a second, the effective date for a USFI right now, based on the proposed regulations, is going to be January 1st, 2013. Now, if for an FFI that's in a non-IGA country, the effective date will be July 1st, 2013. And based on what we've seen in the model agreements, if you're an FFI in an IGA country that has signed an agreement with the IRS, the effective date of these regulations will be January 1st, 2014. So one of the challenges we have at the end of the day here is we could potentially be looking at 3 different effective dates. I know everyone's very hopeful that the IRS will try to align these effective dates, but I think we are going to have to wait and see. I think potentially you could see the USFI and the non-IGA FFI having a July 1, 2013 start date, but it'll be interesting to see if they move it anywhere to the January 1st, 2014. There's some thought that they won't, because there are some public comments by IRS officials that said that they won't move the withholding and reporting effective dates, and they push everything to a January 1, 2014 start date for U.S. withholding agents. That means you'd have to start withholding out of the gate, which probably wouldn't be a good thing as people are trying to struggle with understanding what these forms mean and how to be documented. Also, keep in mind that as we get into the due diligence and we focus on due diligence, your due diligence is going to vary, as well as the downstream withholding and reporting obligations, depending on the entity type that you are dealing with and the ultimate documentation that is collected. So today, for example, you have the U.S. payer or U.S. withholding agent. You're required to report what we call non-exempt recipients on a Form 1099 and to back up withhold if applicable, okay? Now, there's no change really for the most part when you're dealing with a U.S. person. And a U.S. person could be a living, breathing person, or it could be an entity. However, the one thing it's important to note, and I think all of you should know, and this would be interesting to see if there is an impact on the accounts payable side on this as well, is that you're going to now have to document your exempt recipients. The way the draft regulations are written, if you do not have a document for an exempt recipient, meaning a W-9, they're going to be presumed to be a non-participating FFI, subject to 30% FATCA withholding. So I think the message is we're going to have to begin to document, if you will, exempt recipients with a W-9. Now, currently, as a U.S. withholding agent, for your non-U.S. persons, you're used to collecting W-8s. One of the things that the government did, though, or the IRS did, is they created 2 new W-8 bends, one for individuals, which I think is a good thing, and it didn't really change substantially from the original W-8 bend, other than it added a online 2A field for country of citizenship. And then the W-8 bend for entities, which is what they call a W-8 bend E, was released, and that is a 6-page document whereby your entity clients, if you will, are going to have to identify themselves as either some type, as a good or bad, if you will, FFI, or a good or bad NFFE. And to the degree that you've got an NFFE that has substantial U.S. owners and they don't meet one of the exceptions, they are going to have to disclose all of their substantial U.S. owners on the W-8 bend. It's reflected on the last page, or else you're going to have to treat them, as, if you will, as a bad NFFE. So if we go to slide 13, in terms of the substantial U.S. owners, essentially the way the draft regulations are written, it's essentially a 10% or more ownership interest. We go to the next slide. One of the challenges really for the entities is trying to understand what their FATCA classification is. So if you look at, for example, the new W-8 Ben-E, or you look at the new W-8 IMY, there is a new line 4 which the IRS has added to the draft forms W-8, and the line 4 selection really is geared towards capturing what they call the Chapter 4, parenthetical FATCA status. Okay, and so I think it's going to be a challenge, I think, for some people to really figure out what they are. But essentially, they're going to have to find their appropriate FATCA classification. But what's going to happen is it won't be as easy as ticking a box and going to the appropriate section on the W-8 and saying they certify that they're X or Y. One of the things that the W-8 Ben-E and the W-8 IMY do is really expand, if you will, the documentary evidence that has to be collected. And I think that's going to prove to be, besides just the sheer length of the forms and people making mistakes, I think it's going to create some challenges in terms of how do they document or how do they begin to properly classify who their clients, if you will, are. Now, the other thing is the IRS has expanded, if you will, this concept of U.S. indicia, and we'll jump to that in a second. And if we have U.S. indicia, we either have to collect additional documentation, if you will, otherwise we're potentially going to have to fail the form and apply, if you will, the corresponding presumption rules. So if we go to the next slide, we've got outlined here for you the U.S. indicia data elements. I think the two that are probably the most problematic is this concept of a U.S. telephone number and a U.S. place of birth. These are both data elements that people do not collect in the general course, necessarily in the general course of business, or focus on. I mean, obviously there could be a lot of phone numbers associated with the account, but no one is really capturing what country a phone number is from. And it's not as easy looking at an area code. So, for example, I live here in Boston, the area code 617, but if you go to Canada, for example, Ottawa's got a 613 area code, very similar, if you will, to, let's say, the Boston area code. Now, the U.S. place of birth, a lot of times people may see it on a passport, but it's not a data element they necessarily scrub. I think the other one just to be aware of is the second to last one, where you got what we call a POA, power of attorney granted to a person with a U.S. address. That also is something that is going to, I think, be a bit of a challenge. Essentially, if you've got a POA with a U.S. address, you're going to have to get additional documentation to cure it. We go to the next slide. If, as I mentioned before, very similar to the existing Chapter 3 rules, if you have an undocumented, let's say non-U.S. individual, we're going to subject them to 30% withholding. So from a USFI perspective, you'll have the same thing. You will have to apply 30% withholding either to what's called a non-participating FFI or to a non-compliant NFFE. Now, the kicker, though, is you're going to have to apply 30% also to gross proceeds. So that is something that's new. And I know a lot of people are really struggling with, how to manage that. Now, if we go to slide 17, what you can, as I had alluded to earlier, the compliance obligations will start for USFI on January 1st, 2013, but withholding, there is a 1-year, if you will, deferral on withholding. So essentially the thought process was that you could use 2013 to get people exposed to the new forms and potentially remediate the new forms. But then you'd have to worry about withholding effective January 1st, 2014, and then gross proceeds will kick in 2015. The one thing the IRS has left open is this concept of pass-through payments. I'm not going to touch that today because in of itself it's a pretty complicated thing to digest, but if that were to come to pass, that would be a 2017 event at the earliest. Going to slide 18, just to be clear, the FATCA withholding rate of 30% is very much like the NRA rate of withholding is 30%. That's the maximum rate. Okay, but what I want you to be aware of is that if you're going to apply withholding rate, it's going to be one or the other. It will not be both. And I said earlier in the discussion that think of FATCA as a filter that sits on top of the existing rules. So we have to make sure that we satisfy the FATCA requirements. If we do, from a USFI perspective, you go back into your regular Chapter 3 withholding and reporting requirements. If you don't, if you will, you're kind of stuck in FATCA land, and then you have to worry about FATCA withholding and then the FATCA reporting requirements. Now, fortunately, there are some exceptions to withholding. So, for example, short-term interest and OID payments, ECI, the ordinary course of business payments. This is for the accounts payable, this third bullet. The IRS has said sales of fractional sales will be excluded, and then grandfathered obligations. So, you know, at least be aware that there are some exceptions. I'm going to skip slide 20 where we really get into a lot of the grandfathered obligations. And let's go to our first polling question.
Thank you, Cyrus. First polling question, I guess it would be the second polling question, actually, but here's the question. Do I have to apply both FATCA withholding and 1441 withholding if I have an undocumented account holder? Your answers are yes or no, and we will give you a minute to complete this poll. And then, Cyrus, if you want to just continue on with the presentation, that would be great.
Thank you, Melanie. So the next thing that we want to talk about are just the basics of reporting from a USFI perspective. You know, with respect to your U.S. persons, you're still going to report your U.S. persons on a 1099 to the degree that you need to. If you have an undocumented non-U.S. person and you are applying the presumption rules, you're still going to put them on a 1099. Unfortunately, there won't be a 10. For your non-U.S. persons that are documented, they will wind up being reported, if appropriate, on a Form 1042-S. But then if you have to worry about FATCA-related reporting because you had FATCA withholding, that too will be on a Form 1042-S. So you'll see that on 1042-S. One of the other things that you're going to have to be conscious of is that the IRS has yet to define how you are going to report or what the format will be of substantial U.S. owners of NFFEs, but that is something that you are going to have to report to the IRS. The thought and expectation is you should hopefully be able to leverage most of what's provided to you on the last page of the W-8 Ben-E, where you're grabbing, if you will, those details, and then you're obviously going to have to couple it with, if you will, the amount of payments and some other side details. But from a USFI perspective, I think you're going to be able to obviously manage this the way you have. Obviously, for those entities that are outside the U.S. and they weren't a part of the QI regime or some NQIs that did some reporting, obviously getting exposed to the IRS 1042-S and 1099 reporting regime will be a bit of a challenge, if you will, for them, just given that it's new. But, you know, I think you should just pay attention to what's going to get published in Publication 1187 and 1220 for some of the additional reporting requirements. So jumping into, if you will, to the implementation considerations, you know, obviously if the deadline is not extended, there's a lot to do. I mean, January 1st is not that far off. You know, when you think about it, I mean, we're almost in September, so you basically have 4 months, frankly, between now and the end of the year by the time you take out some of the holidays. So obviously the first thing you're going to need to be able to do is to be able to manage the new W-8s. One of the things, you know, we talked about the W-8 Ben, splitting into two parts, the W-8 Ben-E, the W-8 Ben for individuals. And I mentioned that the IRS just released the IMY yesterday. But it's clear that you're going to have to manage these new documents. They are a lot more complicated. If you haven't reviewed them, you really need to review them, and you're going to have to think about the various due diligence requirements that surround getting it sorted. Also, the IRS has said they will be updating the W-9, so you need to be aware of that. And again, also from an accounts payable perspective, please be aware that the W-8s have changed and the W-9s will change, and so you're going to have to manage when you roll those out. The one thing that I should, and I'll just do it here with respect to the W-8s, one of the good bits of news is that what the IRS has done is they're going to have a 6-month sunset period, which means that their intention, at least what they've said thus far, while they've released the drafts and we're waiting for instructions to come, their intention is for these new W-8s to be effective as the 1st of January 2013. And because we have a 6-month sunset period, that means really their effective date will be the 1st of July 2013. And part of the rationale behind that is there are a lot more institutions that are now using electronic, if you will, W-8s. This is both, if you will, FFIs, USFIs, and it's not limited just to those in the financial services world. There are a lot of large number of global multinational corps that are using electronic W-8s and W-9s now, so the IRS realized that you had to allow for enough time programmatically for changes to get done and for people to come in to get an updated MOU. But just be aware of the changes, and I think you have to begin to digest those. We talked briefly about some of the changes on the reporting side, and then, of course, programmatically putting in a withholding or adding in FATCA withholding will take some effort. If we jump to the W-8s themselves, a couple other things to note, just generally speaking about the W-8s, that once FATCA becomes effective, one of the things that it's supposed to do is harmonize, if you will, or talks about harmonizing the FATCA rules with the Chapter 3 rules. And what FATCA did say is original W-8s will no longer be required, which is a very good thing. The only thing is that a withholding agent will have to be able to confirm that the person sent it, in fact, was a person who provided the form. Presumably, you'll have to be able to, I guess, under an audit, be able to show if somebody emailed it to you that you had their email address. Now, another common question that we get asked is, does that mean I have to re-solicit or repaper all my forms? Technically, your existing W-8s and the regs do contemplate this. Your old forms should cycle through potentially through to the end of 2016, but by 2017, you will definitely have to repaper, if you will, all of your, if you will, vendors or all of your account holders with a new W-8. If you are not going to repaper out of the gate but rely on the old W-8s, for example, if you have an FFI, you'll have to go get the FFI EIN number in order to make sure that you can rely on that old W-8. Okay, but essentially, you are going to have to repaper everyone. And I mentioned the 6-month sunset period. The one thing I will say is with these new W-8s and the FATCA regulations, keep in mind everything's proposed. That does not mean you can start accepting copies of W-8s yet, all right? You can't accept copies until the regs become final. And also, don't start resoliciting people with these draft forms W-8. They are only drafts. I would expect that you will see some further changes. For example, on line 4 of the W-8 Ben E, one of the things that we've said to the IRS is, besides recognizing that we've got an exception for merchant reporting, we need to have an exception for vendor payments. So I would expect that you will see some tweaking and some clarity around what's on the W-8s themselves. Another thing to note, if we go to slide 26, I know a lot of people have used affidavits of unchanged status to cure and or document their vendors and or their account holders. It's been often we've used this under audits. It's a ploy we've used to kind of document someone if there's a break or there's an invalid period. Please note that the FATCA regulations now have codified the concept of affidavit of unchanged status, and there is a set methodology that's supposed to be used in order to manage it. So you know, at least be aware of that. And on the age-old capacity issue, heartburn, nothing's changed yet on that. Unfortunately, the FATCA regulations didn't address it. One of the things the IRS has said and continues to say is at some point they want to clear, quote-unquote, the underbrush associated with W-8s, and hopefully they'll help us have a more, if you will, liberal standard around capacities than what they've shown to date under audits. If we jump to the next slide, slide 27, we talked a bit about the W-8s themselves. Mel and I prepared these slides obviously before yesterday, so it doesn't reflect the fact that the new W-8 IMY was out. Please note, though, that an ECI will also be forthcoming. The IRS is going to have to update the W-8 ECI to be probably more in line with the W-8 Ben E and the IMY. But bottom line is, obviously, with the new W-8s, you can appreciate, if you've had a chance to look at them, or if you're looking at the IMY, you can appreciate that it's just a lot more complicated. I think now we have time for our third polling question.
Yep, that's right, Cyrus. Thank you. Third polling question. And before we launch this, it looks like we already did, but just to let everybody know that the slides and the recording for this presentation will be sent to every participant on this event. You should expect those within a week. And then also just a reminder to submit your questions in the Q&A or chat box if you have a question for Cyrus. And the polling question right now is, following the changes for FATCA, how many forms W-8 Ben are there? And your answers, your choices are 1, 2, or 5. And go ahead and answer that. And Cyrus, just go ahead and continue with your presentation.
Okay. Thank you, Melanie. So now we're going to jump into these intergovernmental agreements, often called IGAs. And if that labeling wasn't fun enough, we now have to worry about a model, if you will, 1A, so to speak, and a model 1B. So there are ultimately going to be two versions of this agreement. There is one which we'll just call Model 1 with reciprocity. And essentially, it's agreement with a partner country to exchange information currently obtained under the U.S. tax rules. Okay, and then Model 2, the Model 1, the other option, the Model 1, is without reciprocity, and the U.S. will not exchange information with respect to accounts in the U.S. held by residents of the partner country. Okay, so, you know, what we do know, and at least what it seems with respect to these model agreements, is that you're going to have to either be in a income tax treaty country, or you have to have a tax information exchange agreement in place with the U.S. So, you know, we have to see how that plays out. Now, the Model 1 with reciprocity right now, it's going to be used by the G5, which is France, Germany, Italy, Spain, and the United Kingdom. We know that there will be a Model 2 version that will be released at some point in time. With respect to the IGA with reciprocity, let me just touch on that for a second. The current commitment really by the U.S. is this, is that information relating to U.S. bank deposit accounts in excess of $10 to partner country resident individuals will take place. Other payments made to a partner country residents that are currently subject to reporting will also be included. And then beginning in 2017, the expectation is we will be providing, if you will, the tax identification numbers associated with each one of these reports, or if there isn't, if you will, a foreign tax ID number for a particular country, we will have to provide the date of birth where the partner country does not issue a tax ID number, okay? Now, what of course is interesting is future U.S. commitments through these IGAs with reciprocity. You know, the IRS or the U.S. government's committed to improve the transparency and exchange relationship with a FATCA partner by pursuing and adopting additional regulations and advocating support of relevant regulations. So, you know, I think one of the things that'll be interesting as these IGAs begin to evolve is what kind of, if you will, challenge are U.S. withholding agents going to have to deal with, because obviously U.S. withholding agents will be, if you will, the catalyst for providing this information to the IRS, who in turn would then hand it over to other governments. So I also think another issue just to kind of be aware of it is that I think U.S. withholding agents are definitely going to have to look through corporations and trusts to, but they're going to potentially have to look through corporations and trusts to report FATCA partner residents. So I think we have to just kind of see how that's going to come to play. One of the things to note, though, is although the G5, for example, have noted that they are going to probably subscribe to Model 1, nothing is in effect. So, keep in mind that it can only be effective once the agreement is put in place. And, one of the things I caution people is it could take time to get these agreements done. So I think a real headache is going to be, just take the G5. Everyone's hoping that the agreements are in place, but if they're not, I think people could be surprised that they've got to be ready, if you will, before January 1st, 2014. Now, with respect to due diligence, essentially what happened is, at least with the Model 1 IGA agreements, there's an extension of 6 months. The effective date now becomes January 1st, 2014, as we mentioned before. Also, there's a greater reliance on local AML KYC documentation. But one of the, I think, real headaches, though, is I've noted one here. There are differences now in the definition of various terms. So, you could have a different definition of what a substantial U.S. owner is. There's potentially, other definitions, even frankly, who would qualify as an FFI. Now, we also have one of the things that the IGA has addressed is with respect to withholding. We've got it clear that there will be no withholding associated with FATCA unless, of course, there's U.S. source FedApp payments. So basically, the existing QI rules will stay in effect. And so essentially, that should mean no withholding on gross proceeds or foreign pass-through payments. There's still going to be a reporting obligation, but that reporting obligation would go back to a partner country first or government first, and then they in turn would hand it over to the IRS. Now we're waiting to see what Model 2 is going to look like, but I would assume that we'll see something in the coming weeks, if you will, relating to Model 2. So if we go to the next slide. One of the challenges, of course, is these next steps of, what's going to happen to get these, if you will, agreements in place. And essentially, I think each respective government, as well as the U.S. Department of Treasury, are going to have to finalize these IGAs. And they're going to have, basically, they've got this concept of an annex or appendix that they're going to have to put in place, and that annex can potentially have particular product carve-out or variations, if you will, of some of the entity classifications. It may also mean, though, that the FATCA partner countries / governments are going to have to put in place or pass some rules in order to make the IGA be, if you will, workable within their country. The good news about that is, the U.S. Congress does not need to get involved with that, but I'm sure it can create some tensions in certain jurisdictions in terms of changing the laws to be compliant. And then, of course, we're going to have the FATCA partner agreement between a particular government and the U.S. So again, these things are going to take time. One of the things I think that, particularly for those of you who have a global footprint, I think you're going to have to just be patient and recognize that you potentially could have, for example, 3 different due diligence standards. One from a USFI perspective, because you can only accept W-8s, if you will, W-9s. If you have part of your entities in an IGA-approved country that's executed, if you will, an IGA, they could potentially rely on KYC and or the definitions could change a bit. And then, of course, you've got the issue of, let's say, a non-IGA country and, what that's going to ultimately mean. So I think it's probably just important for you to understand that there probably will be some inconsistencies in terms of how that's managed. And, as I said, things like the FFI definition have changed between the proposed regulation versus the model IGA agreements. And it'll be interesting to see if, with some of these changes, will the IRS go back and sync up the, some of these differences with the final regulations. Well, let me next jump. Actually, I think we're ready for another polling question.
We are ready for another polling question. Thank you, Cyrus. The question here is, has the effective date for FATCA been extended beyond January 1st, 2014, and you have three choices, yes, no, or it depends if applicable to USFI, FFI, or FFI in FATCA partner jurisdiction. And we'll give you another minute to answer that question. And Cyrus, would you like to continue, or are you finished?
I think we're done, right?
Yep, I think so. I think what we'll do here is just give everybody another moment, and then I will introduce our next speaker. Okay, and then we'll be closing the polling question here in just a few moments. Next, I'd like to introduce Jeff Cronin. Jeff is Convey's VP of Product Strategy. And Jeff, take it away.
Thank you, Melanie. First of all, I'd like to thank Cyrus for his expertise and for his time. I know that he's very busy and that this area has been generating a lot of activity for all of us, but especially him. And I want to reach out and say thank you to him personally. And of course, we're going to keep him around for a few extra moments after my comments so that he can answer some questions that you've all been submitting during the course of the event. I wanted to make a quick note and say, thank you all for coming to the event. And Convey is here to work with organizations like CTI and yourselves to not only help you comply with the FATCA documentation requirements, but from Convey's standpoint to help you after the fact with all of the reporting and withholding requirements that are coming along with FATCA. The situation as it stands right now is obviously still evolving as we're waiting for final rules and regulations to come out. Keep your eye out with Convey, Broadridge, and CTI, and we'll be continuing an ongoing series updating you on regulatory changes and updating you on information that's been actually provided by the IRS as it comes out. As a note, one of the first questions they came across is whether or not the draft versions of the W-8s were available, and I can say that one place you can get them from is actually from convey.com. If you click on our blog link, we have on the convey.com blog, we have linked the draft documents for the released W-8s there for you to download, so you can have access to them right there directly. So without further ado, I'm going to hand it back over to Melanie for Q&A.
Great. Thank you, Jeff. And I'd like to echo my thanks to Cyrus as well. It's been great information, Cyrus, and we really appreciate your time very much. So right now we're going to go into Q&A. We've got a lot of questions. And I apologize if we don't get to everybody's question today, but between Cyrus and myself, we will be putting together a top 10 FAQ document, and this will also be sent to all attendees within the next couple of weeks, so you can watch your emails for that. So I'm going to read the first question here. There is, let's see, can the W-8 ban be completed by a client electronically when they become available? Cyrus, would you answer that?
Yes, they can. For example, the IRS allows you to collect what's called electronic W-8, and there's some regulations around that, and I can include that in a write-up for Melanie to distribute to everyone. But one of the things that one does is they get what's called a memorandum of understanding from the IRS, where basically the IRS will bless your system and your logic. So my advice is absolutely you can use a new form. Just go to the IRS, get the MOU. The value of the MOU, by the way, is essentially if you have a form that goes straight through and it doesn't wind up in what we call valid pending queue or needing documentary evidence, the IRS is not interested in looking at that under the scope of an audit. So the nice thing is whether it's accounts payable, whether you're a financial institution, if you have what we call straight through processing, whereby the W-8 is valid all the way through, the nice thing is that helps reduce, if you will, your audit scope. But absolutely, I will tell you, we've been working in earnest to help people get the new logic up and running, and I think you'll see people have it ready within the fourth quarter of this year. So yes, you can. Okay,
great. Thank you, Cyrus. And then the next question is, what is your guess on how the IRS expects USFIs to validate the foreign tax ID requirement on the W-8?
That's a great question. I had an intern, poor thing. She spent her entire summer 2 years ago grabbing every foreign tax ID number that's out there. It's an incredible list. I can't remember how many pages it is. I think it's easily 7, 8 pages long. And it's pretty complicated. There are actually some countries that have 3 different PINs. There are some countries that will have that they do alphanumeric characters or special characters whereby you can identify even a male versus a female. So it really, I think, could create a whole other headache around validations. What I've said to the IRS in some of the discussions, I said the IRS really needs to publish a list for everyone. I think what you're going to see is it's on the Form 1042-S today, and we know it's a required field now on the W-8s. I think that what you'll see happen, and we just have to see the instructions come out to confirm this, I think that they're going to look for something, meaning that you don't necessarily have to validate those out of the gate. And I believe that what you'll see that the Treasury and IRS try to do is, as each one of these IGAs get negotiated, I think one of the things they will ask each one of these countries to do is verify what is the foreign tax ID number, or maybe the equivalent of a national health number or whatever that can be used as a unique identifier to be used for this information exchange. So what I would suspect is potentially, and this is conjecture, but what I would suspect in the early days, whatever got put on the form, you might be able to rely upon. And then, for example, let's say 2016, when they think that they should have a significant number of the IGAs, they will then begin to publish out what the validation standard should be. But it is something that I've impressed upon the IRS that they need to do. For those of you who looked at the IMY that came out yesterday, they even made it a required field on the IMY. So it's clear that they're looking for it everywhere, and if it's going to be a required field, and we have to report on that, clearly the global community, both USFIs and FFIs, need some kind of a template to follow. So hopefully that helps.
Great. That was a great answer, Cyrus. Thank you. Here's another one. What are the requirements for stock borrow loan for manufactured dividends in the context of both the recipient or the payee?
You know what I'd like to do, Melanie, on that one? Let me address that in the write-up, just because there's some variables there on something like that.
Okay. Okay, that sounds great. I know you skipped over the grandfathering, but there is a question: how is grandfathered obligations going to affect withholding? Can you comment on that briefly, or would you rather address that separately?
Yeah. So basically, the idea around grandfathering should be, if you have a grandfathered obligation, you're not going to have to worry about withholding. The one trick around grandfathering, though, is this: that if the terms change, unfortunately, you're going to fall out of that scope of that exception. So, grandfathering, I think, should be a good thing, but, keep in mind, if something changes, you're going to lose, if you will, if the terms are changed, you could potentially lose the exception from withholding.
Okay, that's great. Thank you for answering that. Next question is, how can we accept an electronic version of a W-8 when it is required we keep originals on file?
Okay, great question. One of the things that happens is when you get the MOU, the IRS treats the electronic W-8, it's equivalent of a substitute W-8, A. B, in order to sign the form, you're never going to have a wet ink signature. In fact, what the IRS does require, though, in lieu of the wet ink signature, is the equivalent of a username, password, and PIN. So the last act of filling out the W-8 is providing that PIN. Combining the PIN with the username, password, that's the combination you have for your electronic signature, and that's captured and recognized, whatever your methodology is, back to you in your MOU from the IRS. So essentially, you don't need to have A, original form, and B, what's happening is you're using, if you will, the equivalent of a username, password, and PIN in conjunction with what we call the Federal e-Sign Act to make it a valid electronic signature. So that's how the IRS, if you will, I don't want to say got around the requirement, but that's how they got comfortable, if you will, that the electronic signature is akin to a wedding signature.
Okay, great. The next question here is, has the IRS intimated at a delay due to not releasing final regulations yet?
The IRS, you know, we're all kind of waiting for the IRS to publicly say something again. In some of the conversations we've had, they are sympathetic, recognizing that it takes time to implement. I mean, I think one of the things that the international community did, we had a public hearing, if you will, in May, and a lot of people from around the world came and kind of pled their concerns and tried to, if you will, get the IRS to understand some of the concerns and angst that they were having. But one of the recurring themes is, look, we need time. And people have had a lot of private meetings with the IRS and said, look, to do a major system bill, which this will require, we minimally need 18 to 24 months. I think the IRS is definitely sympathetic to it. I think that's parcel of why you even see under the IGA potentially the expansion, if you will, from the effective date being July 1, 2013 to January 1st, 2013. My conjecture and my speculation is this. I think you will see the USFI start date get pushed 6 months to be July 1, 2013 at a minimum. And the reason why I say that is it kind of makes sense, knowing that the W-8 BEMs are going to be released on January 1, 2013, there's a 6-month sunset period. They really become effective, if you will, July 1, 2013. I think, you know, it makes sense to align July 1, 2013, if you will, as a start date for USFIs and for at least FFIs in a non-IGA executed country. So I'm hopeful that you'll see at least a 6-month start period. Now, you know, unfortunately, I think every day we get past summer and as we get past September, I think people are going to get itchy, and I think more adamant to see an extension of time. And also, I think the government may just have no choice but to comply. So hopefully, I wish they would make an announcement before then, because it would make people's lives a lot easier. But I'm optimistic, cautiously optimistic, I should say, that at least we'll see a 6-month start date. I'm not sure we'll see a January 1, 2014 start date for everyone. And the reason why I say that is at least we've heard Treasury officials say that they're not pushing the withholding and reporting deadlines, which means January 1st, 2014 is the first withholding date, at least for USFIs. So I think it'd be tough to have a new regime put in place and have withholding on day one. I like the idea, if you will, of a transition period. So, you know, long-winded answer. I think, like a lot of you, I'm cautiously, well, hoping, if nothing else, but cautiously optimistic that we will see the effective dates get pushed. I'm not sure we'll see a 2014 effective date. I'll be happy to be surprised, but I'm hopeful for at least a 6-month extension for USFIs.
Great, thank you, Cyrus. One more question, and then we will shut down the presentation just to respect everybody's time. So, Cyrus, the last question is the new W-8 Ben replacing the 8233?
I wish. I hate that form. I have lobbied hard, really hard, and I had presented the IRS mock-ups of the W-8 Ben with some of the 8233 points fused together. Unfortunately, speaking to the people that drafted the W-8s, they felt that they didn't have enough time to get the people who managed the 8233s to come around to their changes, so they were forced to come out with a W-8 Ben for individuals as it stood. I personally can't stand the 8233, and if it's one of the things I will continue to do every year, I will get on my soapbox and continue to squawk about that form. I don't like the fact it's only good for a year. I think it's much more complicated than the W-8 Ben, and on the vendor payment side, it causes a lot of frustration. I'll tell you that even when people have gotten it right, I've helped some people through audits. They do it timely. You don't hear anything from the IRS, and 6 months later, the IRS come back, and then they fail the 8233 for some silly reason. So that form clearly causes some angst, but regrettably, they did not, if you will, fuse the 8233 with the W-8 Ben for individuals. I think, though, the fact that they have, if you will, split the W-8 Ben into two forms, one for individuals, one for entities, it makes it easier now down the road to, if you will, have the 8233 or some components of it morph into an expanded W-8 Ben for individuals. And I think the other thing, too, by the way, just speaking to that, you know, for those of you who were around for the 1441 rules and QI rules, you remember we had, if you will, changes, and we had the forms come out in 98, and then we had some changes in 2000, 2002, and then, of course, we had the 2006 evolution. I would expect that as the IRS and as the industry, both MNCs and the financial services firms, get a little more experience with W-8s, we're all going to learn things. And I think you're going to see that potentially the forms themselves will evolve a little bit. So I would not be surprised if in a couple of years we saw some more changes to the W-8s, if nothing else, clarifications on the instructions and such. But hopefully, you know, as they're making those reviews and enhancements, we will see the end of the 8233 at some point, but not today, unfortunately.
That's great, Cyrus. From the comments, it looks like you're not the only one who feels that way about the 8233. So everybody on the call, it's kind of comforting to know that there's an international tax attorney who doesn't like it either. Okay, Cyrus, thank you. I'm going to shut down the questions now. And but before we end, I would like to just remind everybody that a recorded version of this webinar and the webinar slides will be available to you early next week. So please watch your email inbox. And then also a reminder that CPE certificates will be sent to you if you requested them approximately 1 week after today's presentation. Do not forget to fill out the evaluation that will pop up on your screen when I end the presentation here. Fill out the evaluation if you need CPE credits. That is required from NASBA. And that's pretty much it. That will conclude our webinar for today. The contact info for Cyrus and for Convey and Broadridge is on your screen if you'd like to jot any of those numbers or websites down. And once again, I'd just like to thank Cyrus Daftary. He's wonderful and he gives great information. Thank you, Cyrus, so much for your time and knowledge. And I also want to thank Broadridge for their sponsorship of today's presentation. And thank you all for joining us, and have a great afternoon.
Thank you.
Thank you.